Hello and welcome, dear investors. 2 days ago, Realty Income announced the acquisition of another retail REIT called Spirit Realty. This news resulted in a new sell-off of Realty Income stock, further increasing the dividend yield, which is now at 6.4%. Is the acquisition a good idea? Can Realty Income handle the new debt if there's new debt? Are Realty Income dividends safe, still safe, and is the stock a buy? All answers I give you in this video. My name is Thorsten Tiet. I'm the founder of this website. Very popular. We have more than 105,000 registered members, and it's all about long-term investing to help you profit from long-term sustainable capital gains and growing dividends as well. So let's go. Let's have a look at Realty Income and of course at Spirit Realty also. It's Spirit Realty, and here we have both of these stocks, and this is the news. This is the press release which led to the sell-off, and this is Spirit Realty, the retail REIT being acquired by Realty Income. If we have a look at the portfolio composition, we see that there's a lot of service and there's also discretionary retail, and in my point of view, both discretionary retail but also service retails are cyclical in nature. And service retail was very sensible to Corona lockdowns also, and this cyclical nature, you can see it if you look at the fundamentals here. Just looking at the funds for operation and dividends, you see that it's rather modest performance of the stock. We see no continuous increase of dividends and funds for operations. We see this for Realty Income very nicely for many years already, but for Spirit Realty Income we don't see this. We even have dividend decreases. So it's a more modest appearance of this stock of this company being acquired. And here we need to trust the management of Realty Income, that they know what they do. They gave the what they were thinking about this acquisition here in this press release, and you can read it if you want. Basically, it's a question here of trusting the management, yes or no. They already acquired Varied REIT some years ago, and so far it worked very well. Even if the stock price is at long-term lower, from a fundamental point of view, the acquisition worked. So I think I trust the management in what they are doing. But we have more. I can show you more and hard facts which help you to decide if the stock is a buy right now or not. For example, we can calculate if the stock price is too high for Spirit Realty for this acquisition. You will find in the press release that the enterprise value is 9.3 billion of this acquisition. But be aware, the enterprise value does not correspond to the buying price, which is a burden which can create a new debt or the dilution of new stocks. Because the real buying price or the payment amount is calculated because it's an all-in stock transaction, which means that the acquisition is not paid by cash, but by new shares of Realty Income, and these new shares go to the shareholders of Spirit Realty. They are paid by shares for Realty Income. And for each share you hold of Spirit Realty, you get 0.762 shares, new shares of Realty Income. Now, calculate this 0.76 shares they get with 141 million shares outstanding of Spirit Realty. You see it here, 141 million. And for each of these shares, you get these 1.76 Realty Income shares. And then multiply it with the stock price of Realty Income. I took $48, which is the current stock price, or comes close to the current stock price. And then you get a number of $5.2 billion in new stocks being generated. And this is how Realty Income pays for the acquisition. So they create new stocks worth about 5.2 billion. And the enterprise value is this 5.2 billion in new stocks plus the interest-bearing debt of about 4.4 billion. And this comes together with some goodwill and some cash, which is also in the balance sheet of Spirit Realty, to the complete enterprise value of about 9.3 billion. So, in short words, there is no problem with additional debt because it's not paid by new debt, but by new stocks. But they take in the acquisition also, Realty Income also takes the interest-bearing debt of close to 4 billion. Now it's nice to know that this 4 billion debt, they have an average interest rate of about 3.4 or 3.5%. It's somewhere written here. It's 3.5%, and the weighted average term of maturity is approximately 5 years. This piece of information is interesting because right now the interest rates are very high, but here you see, okay, 3.5%, and the average maturity is 5 years, so it seems okay to me. So there's no big burden by interest coming to Realty Income. So I think the acquisition can be handled by Realty Income from a fundamental point of view. This leads us to the next answer. Are dividends still safe? There, we have no new debt being generated by this acquisition, except of what's taken over by Spirit Realty. That's manageable in my point of view. So you can already say dividends should be safe. They are even more safe because the management assumes that the transaction will increase the adjusted funds from operations by 2.5%, although it's dilutive because we create new stocks. More than 100 million new stocks of Realty Income will be created to pay the Spirit Realty shareholders. Anyway, the adjusted funds from operations per share should still increase by 2.5%. So dividends are safe, and you can now fully calm look at the current dividend yield of Realty Income and see that it's close to all-time high. It's here. It should be. Here it is at 6.4%. The average of the last 5 years is much lower. It's just 4.4%. So it's really a nice buying opportunity for dividend income investors, in my point of view, Realty Income. And we have now the last question. If Realty Income is undervalued. Not long time ago, I already made an analysis on this YouTube channel, and I told you that the stock was already undervalued according to my analysis. And when the stock price was close to here, about $40, now it's even a little bit cheaper. What shall I say but to tell you that the stock is still undervalued, or it looks very attractive to me. So I can add the fair value calculation here, and then we see the fair value calculated on the average multiples within the last 10 years. This is out of the box like this. You can adjust it if you want. 18.5. Today, right now, we have multiple based on adjusted funds from operating earnings of only 12. So the adjusted funds from operating earnings fair value is $74 compared to the stock price, which is much, much lower. Of course, we have another level of interest rates and we have fading consumer or shopping behavior maybe. At least people are afraid, investors are afraid about this. And we have uncertain times in general. Think about the wars, so what's coming next. So I don't think that the average multiple of 80.5 we will see very fast again. But just go with the market right now and make a multiple of only 12. Then we already have, thanks to dividends of 6.4% and of estimated growth of adjusted funds for operations as well, we already have an expected annual yield of 10%. If you really go with the stock market, who really depressed the current multiple, make it, and this is still attractive to me because to me, and this is already the conclusion, I trust the management, what they are doing. Spirit Realty fundamentals don't look as bright as Realty Income's fundamentals do, but I think that management knows what they are doing. Management buys by own shares, by creating new own shares of Realty Income. This is how the Spirit Realty is acquired, so no new debt except what they take from Spirit Realty, and this is manageable. So to me, this is a nice buying opportunity, Realty Income. You can get it with an additional discount right now, the acquisition. I trust the management, and I think at the end, Realty Income gets even stronger, a stronger company than it was before the acquisition. This is my opinion. Maybe you have a different opinion. Maybe I forgot some important aspects. Just drop a comment below. Happy to discuss with you, and see you next video. Thanks for watching. Bye bye.